Hello friends, welcome to our channel Easy Shots of Learning. Today's video is about process costing. In this video, we will discuss about if the process output is divided into two parts and the partly goods are transferred to next process and partly goods are sold in the market, then how the process accounts are prepared. So friends, if you have not yet subscribed my channel, please subscribe my channel, and if you have any query related to this topic, please write me in the comment box. So in this video, we will discuss if the partial output is sold out in the market and partial output is transferred to next process for further processing. Then how the process accounts are prepared with the help of a simple example. Let's start with, in this example, a product passes through three processes X, Y and Z, and the information is the primary material or the raw material input in process X 1000 units costing rupees 1 lakh, the labor cost or the wages paid to the labor costing rupees 30,000 in process X, 17,500 in process Y and 5,000 in process Z. Expenses incurred individually in each process amounted to 6,250 in process X, 2,900 in process Y and 355 in process Z. Now the normal loss on input is 5% in process X, but here the sale value is not given because it is loss of weight. It means there is no units remain so that we can sold out in the market. So in units column we write the normal loss, but in amount column we do not write anything because there is no sale value of normal loss. The normal loss of process Y 10% and process Z 20%. The scrap in process X units are 50 units, in process Y 30 units and in process Z 51 units, and these scraps are sold out in the market at the price of rupees 25 per unit. Now the part of output which are sold in the market after process X, and the selling price of this output is 175 rupees per unit. The part of output which is sold out in the market after process Y at the selling price of rupees 250, and the whole part which is sold out after process Z at the selling price of rupees 400 per unit. The additional information in this example is two-thirds of units in process X, two-thirds units of process X and one half units of process Y. It means one half of process Y transferred to next process and the balance were sold out in the market. It means when we write process X, the output of process X is divided into two parts. Two-thirds is transferred to process Y and the remaining one-third is sold out in the market, and in process Y half is transferred to process Z and other half is sold out in the market, and the whole output of process Z is transferred to the market for sale. And the additional information includes management expenses amounted to 8,750. It means these management expenses and selling and distribution expenses are not related with a particular process account, because these are the expenses related to a company. So these expenses are included in the costing P&L account but not in the process account. So the management expenses amounted to 8,750 and the selling and distribution expenses amounted to 7,000 rupees. We have to prepare the process account and the costing P&L account. So the output of process X is divided into two parts. Two-thirds is transferred to process Y and one-third are sold out in the market. The output of process Y is divided into two parts. Half is transferred to process Z for further processing and other half is sold out in the market, and the output of process Z is transferred to the market for selling. So first we prepare the process X account. On debit side, we have to write all the expenses. So our first expense is input or the primary material. To input, units are 1000, costing rupees 1 lakh. Other additional expenses includes to labor cost or the wages paid to the labor amounted to 30,000, to expenses amounted to 6,250. These are the expenses which are debited in the process account. Now first we have to write the normal loss on the credit side. All the losses are credited in the process account by normal loss, and normal loss is 5% on input. Here our input is 1000 units and normal loss is 5% of 1000, which is 50 units. Now the second loss is scrap. By scrap, units are 50 and these scrap is sold out in the market at the price of rupees 25 per unit. So here the net realizable value from the sale of scrap amounted to 1250. Now we have to follow 3 steps to calculate cost per unit of this process. So in step number first we have to calculate the normal output, and the formula to calculate normal output is input minus normal loss. Here input units are 1000 and our normal loss in process X includes normal loss and scrap 100 units. So our normal output in this process 900 units. Now in second step we have to compare the actual output with normal output. So the actual output is not given here. So actual output equals to normal output equals to 900 units. Now this is the output of this process. In step number third, we calculate cost per unit. And the formula to calculate cost per unit is total cost minus net realizable value divided by normal output. Here the total cost includes number 1, input 1 lakh rupees, labor cost 30,000 and expenses 6,250. So our total cost is 1,36,250 minus net realizable value, that is the sale value of scrap 1,250 rupees. So we have to deduct net realizable value from the total cost 1,250 divided by normal output, which is 900 units. So the cost per unit of this process is 150 rupees per unit. Now the output of process X is divided into 2 parts. So process X output is 900 units and these 900 units are divided into 2 parts. 2/3 of 900, which is 600 units, are transferred to process Y for further processing, and the remaining 1/3 part of 900 units, that is 300 units, are sold out in the market through costing P&L account. So first we have to transfer these units at cost price to the costing P&L account. Then after we sold these units through costing P&L account. So on credit side, we divide our output by process Y account. Number of units are 600 and the costing per unit is 600 into 150, that is 90,000 rupees. And the balancing output is transferred to costing P&L, which we have to sold out. So units are 300 at the cost price of 150 rupees. So 300 units are transferred to costing P&L for sale. So now we have to total the debit and the credit side to find out the balancing value. But here there is no balancing value. So on debit side, our number of units are 1000 and in amount column 1,36,250. The same amount on the credit side because there is no balancing value 36,250. Now these 600 units are transferred to process Y for further processing, costing rupees 90,000. So when we prepare the process Y account, first we have to include the inputs that are transferred from process X account. So to process X account, our units are 600, costing rupees 90,000. The additional expenses in process Y includes to labor cost, that is 17,500, and expenses 2,900. Now again, first we have to consider the losses and scrap, which we have to credit on the process account by normal loss. Here the normal loss is 10% on input, and the input of this process is 600 units. So our normal loss is 10% of 600, which is 60 units, and there is no the sale value of this normal loss. It is loss of weight, so we don't write anything on the amount in the amount column. The second entry is by scrap, and scrap units here 30 units, which are sold out in the market at the price of rupees 25 per unit. So the net realizable value here 750 rupees. Now first we have to calculate the normal output, and the formula to calculate normal output is input minus normal loss. Here input units are 600 and normal loss consists of normal loss, which is 60 units, and scrap, which is 30 units, that is 90 units. So our normal output here is 510 units. Now step number second, we have to compare the actual output with normal output, but here there is no actual output, so our normal output is actual output, which is 510 units. Now in step number 3, we calculate cost per unit, and the formula to calculate cost per unit is total cost minus net realizable value divided by normal output. Here the total cost consists of the goods which are transferred from process X costing rupees 90,000, labor cost 17,500, and expenses 2,900. So our total cost here is 1,10,400 minus net realizable value, that is the sale value of scrap, which is 750 rupees, minus 750 rupees divided by normal output, that is 510 units. So our cost per unit of process Y is 215 rupees per unit. So here the output of process Y is again divided into two parts. So the output of process Y is 510 units. The half part is transferred to process Z. So half of 510 units, that is 255 units, are transferred to process Z for further processing, and the other half is sold out in the market. Half of 510, which is again 255 units, which is sold out in the market through costing P&L account. So our first entry is by transfer entry, which is by process Z account. Number of units are 255, which are transferred at the price of this process, which is 210 rupees per unit. So in amount column, 54,825 rupees, and the balance output it transferred to costing P&L for sale by costing P&L account. Number of units are 255 and cost per unit is 210. Sorry, 215 is our cost per unit. 215. So in units 255 and in amount 54,825. So on debit side our total units are 600 and amount 1,10,400. the same amount on the credit side because there is no balancing value, 10,400. Now these 255 units at the price of 215 are transferred to process Z for further processing, and the balance units are sold out through costing P&L account. So our next process is process Z. First we have to write the units which are transferred from process Y. So to process Y account, units are 255, costing 54,825. The additional expenses of process Z includes number one, to labor cost costing 5,000 and to expenses costing rupees 355. So these are our total expenses. Now on the credit side, first we have to write the normal loss, and the normal loss is 20% on input. Here the input units are 255 and normal loss is 20% of 255, which is 51 units. By scrap units are also 51, and these 51 units are sold out in the market at the price of rupees 25 per unit. So the net realizable value here is 1,275 rupees. Now again we follow these three steps to calculate cost per unit. Our first step is normal output, and the formula is input minus normal loss. Here the input are 255 units minus normal loss, that is 51 plus 51 equals to 102 units. So our normal output is 153 units. In step number 2, we compare normal output with actual output. So here there is no actual output, so normal output equals to actual output, which is 153 units. And in step number 3, cost per unit, and the formula to calculate cost per unit is total cost minus net realizable value divided by normal output. Here the total cost consists of 54,825 from the goods which are transferred from process Y, 5,000 labor cost and 355 expenses. So our total cost here 60,180 rupees minus net realizable value, which is 1,275, divided by normal output 153 units. So the cost per unit of process Z is 385 rupees. So these all the units of process or the output of process Z is transferred to costing P&L for sale because it is last process. So by costing P&L account, our units are 153 and the cost per unit is 385 rupees. So in amount column, 58,905 rupees. So again we total the debit and the credit side, 255 in units, and in amount 60,118. Same amount in units on credit side, 60,180 rupees. Now we prepared the costing P&L account to find out the net profit of the company. So first we have to see how many output are sold out after each process. So in process X account, 300 units are sold out costing 45,000. In process Y, 255 units are sold out costing 54,825, and in process Z, 153 units are sold out costing rupees 58,905. So first we write the cost of sales. So on the debit side, to cost of sales, all the units which are sold out in the market from process X account process Y and process Z. These are transfer entries. So in process X, 300 units are sold out, costing 45,000. Process Y, 255 units are sold out, costing 54,825. And in process Z, 153 units are sold out, costing 58,905 rupees. Now we debit the additional expenses, which includes number 1, management expenses costing rupees 8,750 and selling and distribution expenses costing rupees 7,000. Now on credit side, we have to write the sales and the selling price after each process which is sold out in the market are number 1, the selling price of the output which is sold out after process X is 175 rupees, process Y 250 rupees per unit, and in process Z 400 per unit. So we multiply the number of units with the selling price to find out the sale. So in process X, number of units are 300 and the selling price per unit is 175 rupees. So our sales are 52,500. In process Y, number of units are 255 which are sold out in the market at the selling price of 250 rupees, amounted to 63,750. And process Z units are sold out in the market at the selling price of 400 rupees. So 153 into 400. So our sales in process Z 61,200. Now first we have to total the credit side to find out the profit. So our number of units are 708, amounted to 1,77,450. Again we write these units on the debit side to find out the balancing value. So the balancing value or the net profit of the company after selling 708 units is 2,970 rupees. So friends, in this video, first we understand how the partly output is sold out in the market and partly output is transferred to next process, and in this case how the process accounts are prepared and costing P&L account is prepared. So friends, if you like this video, share this video and subscribe the channel. Thank you so much. Have a nice day.